name is Melinda, and today we are going to simplify investment concepts, making it easier for you to gain control over your money and help you achieve a better sense of financial well-being and retire well. Let's get right into it. Today, I want to cover 4 essential things. Investing Concepts 101, mixing it up, what is an investment mix, the fundamentals of investment funds, and consider professional investment advice. So let's go. Let's start with you. Think about how would you answer the following questions. When do you plan on retiring? What other retirement goals might you have? These questions are important because it can help guide you on how to invest and keep you motivated and stay on track. For example, I want to retire early, work part-time, and volunteer at a local children's hospital, but still have enough money to last through my retirement. Having that vision in the back of my head when I'm considering spending money now helps prioritize where my money goes. But saving may only get me so far. Once you envision your future goals, it's a good idea to calculate how much retirement savings you'll need to meet these goals. It's an essential step in order to create a plan on how to put your money to work through investing. There are 3 key elements to investing, and they are value, asset classes, which are stocks, bonds, and cash, time, how long you can invest to meet a specific goal, risk, what is your comfort level, and how long do you have to make money. Let's dig a little deeper. Value. Stocks are relatively higher risk, but have the potential for higher reward. Stocks are purchased shares of ownership in a public traded company. Bonds are IOUs issued by governments, municipalities, or corporations with the promise of a return of principal and interest. Many bonds carry a moderate amount of risk. Cash is the least risky and is intended to preserve your money and are in the form of things like treasury bills and certificates of deposit. Time is precious and is a key factor for investing. Consider how long you have before you need to use the money you're investing. For example, if you start investing for retirement when you're just beginning your career, you might have 40 years or more. That might mean investing more heavily in stocks since you are less worried about market volatility. If you're much closer to retirement, you may want to consider a mix of bonds and cash because they typically expose you to a less short-term volatility. Risk takes many forms, not just when the market is sliding downward. There are other factors that can erode your investment gains and reduce the value of your money over time. Here are a few things you need to be aware of. Investment risk. This is the one most people think of when they hear the word risk. It means the chance that the market changes will occur and change the value of your investment and go down. Inflation risk, similar to the way that inflation can affect the value of your dollar at the grocery store, this is the risk that inflation will negatively impact the value of your investments. Longevity risk is the chance that we'll outlive our savings. Withdrawal risk is drawing down your money too quickly in retirement and not having enough to live on in the later years of retirement. How do you put these concepts together? With investing, it's all about finding the right mix for your particular needs. To build a diversified portfolio, the right mix of stocks, bonds, and cash are needed. The combination of these 3 investment asset classes is known as your asset allocation. How you spread your money among each of these asset classes is called diversification. When you diversify, you spread your risk. This is another important tenet of investing and important to get right. By diversifying, you reduce the risk that poor performance in a single investment could greatly affect the return of your overall portfolio. Bear in mind that asset allocation and diversification do not guarantee a profit or protect against loss in a declining market. Another important strategy is to rebalance your portfolio as time goes on. For example, you may have invested 50% in stock, 30% in bonds, and 20% in cash when you're enrolled in a plan. Over time, as the market changes and your investments fluctuate, your percentages will look different. To return back to your original mix, you want to rebalance. Let's talk about funds. What is a mutual fund? They are a pool of assets or securities that are owned mutually by many investors. These are common investments found in employee retirement savings plans. When you're considering where to invest, it is important to consider the following factors of the fund. Composition. Be sure to know what the fund investing in and what asset classes the fund most mirrors. Benchmark. A comparison tool to help you figure out how your fund is doing. Independent ratings. With so many mutual funds out there and companies pushing their own funds, independent research helps you know what funds are right for you. Performance. Measure your fund's performance against that of a peer or funds investing in the same category. Expenses. What expenses are associated with your fund? Is it comparable to a similar fund in the same category? Many retirement plans offer target date or lifestyle funds that are a combination of asset classes geared towards your retirement date or lifestyle. For example, you may expect to retire in the year 2035. A 2035 target date fund would be suitably invested for you today and will automatically adjust gradually to become more conservative as you approach that date. An investment in a target date fund is not guaranteed at any time, including on or after the target date. There is a lot that goes into an investment plan, and this time you may be looking for help. A financial advisor can work with you to create an investment strategy geared towards your specific goals. So, quick recap: set your goals and get down to basics. Once you decided to contribute to your workplace plan or other retirement savings, be sure you are invested accordingly to your comfort level, time horizon, and financial need. Once invested, be sure you are diversified and rebalance your assets over time. And if at all this seems too challenging or time-consuming, get some sound advice, get a plan, and get going. Don't forget to give yourself permission to have a little fun, live a little, save a little, and remember it is never too late to start getting your finances in order so you can live the best life you can envision. Please continue to check back for more sessions. Thank you.